Hello everyone, welcome back to Alicia Perspective YouTube channel. Today we will be talking on impact of inflation on investments. Inflation is one of the most significant factors that can affect any investment portfolio. As the cost of living continues to rise, it can eat away at the returns on your investment and derail your financial goals. While inflation can be challenging to predict, it's essential to understand its implications and how to navigate its impact on investments. Without proper planning and strategies in place, inflation can wipe out the value of your investments and make it challenging to achieve long-term financial objectives. In this video, we will explore some of the best strategies for managing the impact of inflation on your investments, so you can continue to grow your wealth and reach your financial goals despite the challenges presented by rising prices. 1. Understanding the basics. What is inflation and how does it impact investments? Inflation is a fundamental concept that plays a crucial role in the world of investments. Simply put, inflation refers to the increase in the general price level of goods and services over time. As the cost of living rises, the purchasing power of currency decreases. This can have a significant impact on investments and financial planning. When it comes to investments, inflation erodes the value of money. Let's say, for example, you have $100,000 invested in a low-risk bond with a fixed interest rate of 2%. If the inflation rate is 3%, the real return on your investment is actually negative, because the purchasing power of your money is decreasing faster than the interest is accumulating. This is why it is important to understand the impact of inflation on investments. If your investments are not keeping pace with inflation, you are essentially losing money in real terms. Inflation can eat into your returns and hinder your ability to achieve long-term financial goals. 2. The effects of inflation on different types of investments. Inflation has a profound impact on investments, and understanding how it affects different types of investments is crucial for successful financial planning. Let's explore some key effects inflation can have on various investment vehicles. Point 1. Stocks. Inflation can influence stock prices in multiple ways. On one hand, companies with strong pricing power may be able to pass on increased costs to consumers, maintaining their profitability. As a result, their stock prices may rise during inflationary periods. On the other hand, rising inflation can erode the purchasing power of consumers, leading to decreased consumer spending and potentially affecting the earnings of companies. This can negatively impact stock prices, especially for companies that struggle to adapt to changing economic conditions. Point 2. Bonds. Bonds are often considered a safer investment option, but inflation poses a risk to their returns. When inflation rises, the purchasing power of the fixed interest payments received from bonds decreases. This can result in a decrease in the attractiveness of bonds, leading to lower demand and potentially lower prices. Investors may also demand higher interest rates on newly issued bonds to compensate for the expected loss in purchasing power. Consequently, bond prices and yields have an inverse relationship to inflation. Point 3. Real estate. Real estate investments have historically shown resilience against inflation. During inflationary periods, property values tend to rise, leading to potential capital appreciation. Additionally, real estate investments, such as rental properties, can provide a hedge against inflation as rental income may increase with rising prices. However, it's important to note that not all real estate investments perform equally during inflation. Factors such as location, property type, and rental market dynamics can significantly impact the performance of real estate investments in an inflationary environment. 3. Strategies for protecting your investments against inflation. Protecting your investments against inflation is crucial for long-term financial success. As inflation erodes the purchasing power of your money over time, it is essential to implement strategies that can help your investments outpace inflation and maintain their value. One effective strategy is diversification. By spreading your investments across different asset classes such as stocks, bonds, real estate, and commodities, you can potentially mitigate the impact of inflation on your overall portfolio. Different asset classes tend to react differently to inflation, so having a diversified portfolio can help offset losses in one area with gains in another. Another strategy to combat inflation is investing in assets that have historically shown resilience during inflationary periods. For example, real estate investments have often performed well during inflationary periods, as property values and rental income tend to rise alongside inflation. Investing in dividend-paying stocks of companies with strong pricing power can also be beneficial, as they have the ability to increase prices in response to inflation, leading to potential higher returns. Regularly reviewing and adjusting your investment portfolio is essential to stay ahead of inflation. Rebalancing your portfolio periodically can help maintain your desired asset allocation and ensure that you are well positioned to navigate the impact of inflation. A. Diversify your portfolio. Diversifying your portfolio is a crucial strategy to navigate the impact of inflation on your investments. Inflation can erode the purchasing power of your money over time, making it essential to have a diversified investment approach that can withstand its effects. When you diversify your portfolio, you spread your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This helps to reduce the risk of having all your eggs in one basket and increases the potential for higher returns. By investing in a variety of asset classes, you can potentially offset any losses incurred in one area with gains in another. For example, during periods of high inflation, stocks and commodities might perform well, providing a hedge against rising prices. It is crucial to regularly review and rebalance your portfolio to ensure it remains diversified. As market conditions and economic factors change, asset classes may perform differently, leading to a shift in the overall allocation of your portfolio. By periodically rebalancing, you can maintain your desired level of diversification and potentially maximize your investment returns. B. Consider inflation-protected securities. When it comes to investing, one of the challenges that investors face is the impact of inflation. Inflation erodes the purchasing power of money over time, making it essential for investors to consider strategies that can protect their investments from its effects. One strategy that can help navigate the impact of inflation is investing in inflation-protected securities. Inflation-protected securities, also known as Treasury inflation-protected securities, TIPS, are bonds issued by the government that are designed to provide protection against inflation. These securities offer a unique feature. Their principal value adjusts with changes in the Consumer Price Index, CPI, which is a measure of inflation. This means that as inflation rises, the value of the principal increases, providing investors with a hedge against the eroding effects of inflation. By investing in inflation-protected securities, investors can ensure that their money maintains its purchasing power over time. This is particularly important for long-term investors who want to preserve the value of their investments and secure a stable income in the face of rising prices. Circa invest in real assets. When it comes to navigating the impact of inflation on investments, one strategy that stands out is investing in real assets. Real assets refer to tangible assets that hold intrinsic value, such as real estate, commodities, and infrastructure. One of the main advantages of investing in real assets is their ability to provide a hedge against inflation. Unlike financial assets like stocks or bonds, real assets have the potential to increase in value over time, keeping pace with or even outpacing inflation rates. For example, real estate properties often appreciate in value, especially in high-demand areas. This appreciation can help offset the erosion of purchasing power caused by inflation. Investing in real assets also provides diversification benefits to an investment portfolio. Real assets have a low correlation with traditional financial assets, meaning that their performance is not strongly tied to stock market movements. This diversification can help mitigate risks and potentially enhance overall portfolio returns. In summary, investing in real assets can be an effective strategy to navigate the impact of inflation on investments. By providing a potential hedge against inflation, generating income streams, and offering diversification benefits, real assets can contribute to long-term investment success in an inflationary environment. D. Regularly review and adjust your investment strategy. Regularly reviewing and adjusting your investment strategy is crucial to navigate the impact of inflation on your investments successfully. Inflation can erode the purchasing power of your money over time, making it essential to stay proactive and make informed decisions. One strategy is to schedule regular check-ins with your financial advisor or investment manager. By keeping a close eye on your portfolio, you can assess its performance and make any necessary adjustments. This could involve rebalancing your investments, diversifying your portfolio, or considering new investment opportunities that align with current economic conditions. Monitoring market trends and staying informed about inflation rates is also vital. Inflation can vary over time and across different sectors, so it's important to stay updated on the latest economic data and indicators. This information can provide valuable insights into which investments may be more resilient to inflationary pressures. It is worth noting that it's essential to strike a balance between being proactive and avoiding unnecessary changes. Avoid making impulsive decisions based solely on short-term market fluctuations or inflationary concerns. Instead, take a measured approach that considers your risk tolerance, investment horizon, and financial goals. We hope you found our video on impact of inflation on investments helpful and informative. Inflation can have a significant impact on your investments, but with the right strategies, you can navigate this challenge and achieve success. By diversifying your portfolio, investing in assets that historically outpace inflation, and regularly reviewing and adjusting your investments, you can mitigate the effects of inflation and potentially even increase your wealth over time. Remember, staying informed and proactive is key when it comes to successfully navigating the impact of inflation on your investments. Happy investing! Thanks for watching.